Here's where it gets really interesting. For decades, the paper market kept prices suppressed, but something changed in November 2025, November 28th, 2025. The CME Group, the exchange that handles silver futures, experienced what they called a server cooling issue. The outage lasted over 10 hours. During that outage, silver spiked to $56.72, an all-time high at that moment. When systems came back online, bid-ask spreads were over $1. That's illiquidity. That's what happens when a paper market faces stress. And here's the key detail. According to COMEX data, open interest in silver futures represents approximately 244% of vaulted silver. Think about what that means. If even half of the paper contract holders demand physical delivery, there isn't enough silver to deliver. The system is built on the assumption that most contracts get rolled over or cash settled. But what happens when that assumption breaks? That's what we're watching right now. The data. Nobody's reporting. Let me show you some numbers that paint a very specific picture. COMEX registered silver, that's the silver available for delivery against futures contracts, stood at approximately 113 million ounces in early December 2025. Sounds like a lot. It's not. Global silver demand is 1.2 billion ounces annually. That means COMEX registered inventories represent about 34 days of global consumption, 1 month. And it's been draining. In October 2025, silver lease rates hit approximately 30% annualized. Let me explain what that means. Lease rates are what people pay to borrow silver. When lease rates spike to 30%, it means there's desperate demand for physical metal. People are willing to pay 30% interest just to borrow silver. That's not normal market behavior. That's a squeeze forming. Then there's the premium situation. 3 years ago, American Silver Eagles traded at around $2 over spot price. Generic silver rounds at maybe $1 over. Today, Eagles are $8 to $10 over spot. Generic rounds $5 to $6 over. These premiums represent scarcity in the physical market. Dealers are paying more to source product and passing it to buyers. And these premiums have been rising consistently throughout 2025, even as spot prices climbed. And then there's what some analysts claim about institutional accumulation. According to various reports, JP Morgan has been accumulating silver since 2011. Some estimates suggest they hold approximately 169 million ounces in COMEX vaults, representing roughly 40% of total COMEX registered and eligible inventories combined. I can't verify these numbers independently, but if accurate, it tells you something. The bank that helps write the rules has been quietly positioning on the long side for 14 years, where the price is actually going. Now, let's talk about what everyone really wants to know. Where is silver going from $77? Let me show you 3 different frameworks for thinking about this. Framework 1, inflation-adjusted historical high silver hit $49.45 in January 1980. When you adjust for inflation, that's approximately $177 per ounce in today's dollars. We're at $77. That's still 56% below the inflation-adjusted 1980 peak. But remember, the fundamental case for silver is stronger now than it was in 1980. Industrial demand is higher, supply constraints are tighter, currency debasement is more extreme. If silver simply matches its inflation-adjusted high, we're looking at $175. Framework. 2. The gold-silver ratio. Throughout history, silver has tracked gold at various ratios. The historical average is somewhere between 15:1 and 16:1. That means 15 ounces of silver equals 1 ounce of gold. Gold is currently trading around $2,620 per ounce as of December 27, 2025. If the ratio reverts to even 21, silver hits $131. If it goes to the historical average of 15:1, silver hits $175. These aren't speculative targets. This is mean reversion. Framework. 3. The supply-demand squeeze. This is the most important framework. When you have structural deficits of 300 plus million ounces per year, above-ground stockpiles draining, and COMEX inventories representing only 34 days of global consumption, the question isn't if price goes higher. It's how high does it need to go to either increase supply or decrease demand. Increasing supply takes 5 to 10 years. You need to discover deposits, get permits, build mines, process ore. That's not happening quickly. So price must rise to destroy demand. At what price do industries stop using silver? At what price do solar panel manufacturers find substitutes? At what price do electric vehicle makers redesign components? Some analysts suggest that number is north of $100, possibly $150 or higher, because silver is such a small component of total product cost that even at $150, it's still economical to use it. If that's true, price could go significantly higher before demand destruction occurs. Put these 3 frameworks together and you get a range. Conservative case, $130 to $180. Moderate case, $180 to $250. Aggressive case, 250 plus. I'm not predicting which happens. I'm showing you what the data and historical precedent suggest is possible. The massive mistake everyone makes now. Let me show you the psychological trap that destroys people in precious metals markets. The mistake is thinking in terms of, is it too late? Or should I wait for a pullback? Here's what history shows. In 1979, when silver was at $6, people said, it's too high, I'll wait for $5. Silver went to $10. At $10, people said, it's too high, I'll wait for $8. Silver went to $20. At $20, people said, it's definitely too high, I'll wait for a correction. Silver went to $49. The people who bought at $6 and felt uncomfortable did better than the people who waited for the perfect entry and never got it. In 2011, gold went from $1,000 to $1,900. The entire way up, people were calling the top. It's too late. It's too late. It's too late. The people who bought at $100 and felt nervous did better than the people who waited for $1,000 and watched it go to $1,900 without them. The pattern is consistent. In secular bull markets driven by structural factors, not speculation, trying to time the exact bottom costs you more than paying the current price. But here's the deeper issue. Most people are thinking about silver as a trade. Buy low, sell high. That's not what this is. This is about recognizing that the monetary system itself is breaking. Since 1971, when Nixon closed the gold window, the dollar has been pure fiat, backed by confidence, not tangible assets. And for 50 years, that worked. But confidence is cracking. The US debt is $36 trillion. Interest payments exceed $1 trillion annually. The Federal Reserve printed $5 trillion in 2 years during COVID. Inflation persists despite official narratives. Silver isn't going up. The dollar is going down. And when you understand that, is $77 too high? Becomes the wrong question. The right question is, do I want to hold depreciating currency or appreciating metal? The timeline and what happens next. Let me show you what I'm watching over the next 6 to 18 months. Immediate term, January to March 2026. We're in price discovery right now. Silver just broke 45 years of resistance. There's no technical resistance above $77 because we've never been here before. The market is trying to find where equilibrium is. I expect volatility. We could see profit taking that takes silver back to $65 or $70. That would be normal. But I also expect those dips to get bought aggressively because the structural drivers haven't changed. Watch COMEX inventories. If registered silver drops below 100 million ounces, we could see another spike. Watch lease rates. If they stay elevated above 20%, it confirms tightness. Watch premiums on physical products. If they widen further, it means the disconnect between paper and physical is accelerating. Medium term, April to December 2026. This is where the supply crisis could become critical. Mint suspensions, allocation systems, extended delivery times, these are canaries in the coal mine. If major sovereign mints can't source blanks, it forces all demand to fewer and fewer sources. That creates a cascading tightness. Dealers can't get product. Buyers can't find supply. Premiums explode. And when premiums get too wide, people start questioning the paper price entirely. I'm watching for $100 silver by mid-2026. Not because of speculation, but because that's where supply and demand fundamentals suggest equilibrium might be. Longer term, 2027 and beyond. If the structural deficit continues, if industrial demand keeps growing, if supply can't respond, we're looking at a multi-year bull market. Not a quick spike like 1980. A sustained repricing of silver's value relative to its scarcity and utility. Some analysts talk about $150, $200, even $300 silver. I can't predict that, but I can tell you this. The last time silver had structural deficits this severe, the price went from $4 to $49 in 24 months. And the fundamental case is stronger now. What this means for you. I'm not a financial advisor. I'm not telling you to buy or sell anything. But I am telling you to understand what's happening. Silver at $77 is not the end of a move. It's potentially the beginning of a repricing. The industrial demand isn't going away. Electric vehicles aren't going back to combustion engines. Solar panels aren't being uninstalled. 5G towers aren't being torn down. That silver consumption is locked in. The supply can't increase meaningfully for 5 to 10 years. Mining doesn't happen overnight. And 70% of silver is a byproduct, which means it's not responsive to silver prices alone. The paper market is showing stress. Lease rates at 30%, COMEX inventories draining, bid-ask spreads widening during technical outages. These are symptoms of a market that's breaking. If you're asking, is it too late? You're asking the wrong question. The question is whether you understand the structural forces at play. If you do, $77 billion doesn't look expensive. It looks like the early innings, but let me be clear about something else. Volatility is coming. Silver could pull back to $65. It could pull back to $55. That's not the end of the move. That's normal price discovery in an asset that's been suppressed for 45 years. The people who get destroyed are the ones who buy at $77, see it drop to $60, panic, and sell, then watch it go to $120 and feel like they made a mistake. If you're going to participate, you need to understand this isn't a trade. It's positioning for a structural shift in the monetary system. The big picture. Let me zoom out and show you what this is really about. For 50 years, since 1971, the world has operated on a pure fiat monetary system. No gold backing, no silver backing, just confidence in government promises. And for 50 years, that worked, but confidence is finite. The United States has printed $8 trillion since 2008. Debt is $36 trillion and growing $2 trillion per year. Other nations are doing the same. Japan, Europe, China. Everyone's printing, everyone's borrowing, and nobody's paying it back. When confidence in fiat currencies breaks, and history says it always does eventually, money flows to tangible assets. Gold, silver, real estate, productive businesses, things that cannot be printed. Gold is at $2,720 per ounce. It's already repricing. Silver at $77 is beginning the same process, not because of speculation, because the monetary system itself is showing cracks. The people who understand this aren't asking, is it too late? They're asking, how much of my wealth do I want in depreciating paper versus appreciating metal? That's the real question. Final thoughts. Silver hit $77.42 on December 27th, 2025, the highest price in recorded history. And I believe this isn't the top. It's the beginning of a multi-year repricing driven by structural supply deficits, industrial demand explosion, and paper market stress. Is it too late to position yourself? That depends on your time horizon. If you're trying to trade the next 10% move, maybe you're late. If you're trying to protect wealth over the next 3 to 5 years as the monetary system shows increasing stress, you're early. The pattern from history is clear. In 1980, silver went from $6 to $49. People who bought at $10, $15, $20 all did well. The ones who waited for the perfect entry missed the move entirely. I'm watching this in real time. The data, the supply chain signals, the COMEX stress, the institutional positioning, everything points to the same conclusion. This move has further to go. You don't have to believe me, but you should study the data yourself. Look at COMEX inventories, check lease rates, watch premiums on physical products, read mining supply reports, follow industrial demand projections. The story is there. It's been building for years, and now it's accelerating. $77 per ounce. Is it too late? I don't think so, but time will tell. If you found this analysis valuable, subscribe to the channel. I'll be tracking the situation as it develops, sharing data, patterns, and observations, because whether you invest in silver or not, understanding what's happening in precious metals tells you something critical about the health of the broader financial system. And right now, that system is showing stress in ways we haven't seen in decades. What do you think? Is silver going to $100, $150, $200? Or is this the top and we're headed for a crash? Drop your thoughts in the comments. I'm genuinely curious what you're seeing and thinking as this unfolds. This is history happening in real time, and we're watching it together.